Sean at Quest Trust Company. Thank you for joining today for our Tuesday class. Today we'll be going over building wealth strategies with IRA accounts, specifically self-directed ones. This is a fantastic class for anybody who this may be your first time watching this video. This may be your first time dabbling with self-directed IRAs or just IRAs in general, and you're kind of trying to understand what plan might be right for you. Well, how these plans function, why are we any different, what's all the fuss about. This is going to be a fantastic class for that. Just so you all are aware, this is streamed on not only YouTube but also Facebook, so please feel free to shoot your comments in at any point in time. We have a moderator on this call as well that will be able to answer any questions as we move forward. And if there are any questions that I see on the chat box that I think might be a good one to address as we have the presentation, I'll go ahead and stop and answer that question when I get a chance. So let me go ahead and I'm going to go ahead and share my screen. So I'm going to add this right here to my screen here. And so I'm one of the IRA specialists here at Quest Trust Company. The little CISP next to my name just means Certified IRA Services Professional. Just means I've taken an exam and proved that I know a lot of things about IRA accounts as it relates to publication. And I know what you can and cannot do with them. And then, of course, here at Quest, I also understand our processes very well when it comes to how do we invest these privately. Well, it's Quest Trust Company. We're the premier self-directed IRA custodian. We're located in Texas. I'm here in Houston. We also have offices in Austin and in Dallas. We do three things, primarily real estate, promissory notes, and investments into private entities, companies. We also do things into oil and gas and such like that. That's the best thing about self-direction. It's up to the client. We do constant free education. So this is one example of our free online classes that happen every single Tuesday. We also have one that happens every Saturday. And I'll be going over a few other events that we have for you guys that are free to attend or to attend in general throughout the year. And then we have fast and friendly service without expedited fees. We always want to help you out. Our biggest thing is customer service. If you give us a call, you speak to a person every single time. And if you want to chat with me, you just give me a call. If you go on the website, you can chat with me even on the website right then and there without having to call in. So just as an example of some of the education that we provide, these are some of the classes that we actually have on our website, free to anyone to view. Throughout my presentation today, I'm going to actually be talking on some topics, and instead of getting into deep detail on each one of them, I will actually allude to some of the classes that you can go on the website and see. So for example, when we get to the part where we're talking about how you can go from a traditional to a Roth IRA, there is a Roth conversions class that touches on that topic specifically. And that right there will be on our website, questtrustcompany.com. You click on webinars, you click the view or education webinars, and then from there you will find a list of a bunch. This is just some of the ones that we have on there for you to watch on your own time. And then one of the biggest events of the year that we host, if you're an individual that's not necessarily only looking for retirement accounts, but also looking to invest just in private assets in general, maybe expand your network, maybe even, just meet people in the industry. Maybe you are a client of us already and you're looking for opportunities. Maybe you are an individual looking for money and want opportunities. This Quest Expo event is a massive event. Before COVID started, we actually put it on every single year, and they were a huge hit. We did it twice in Houston, once in Dallas, and I had a great time joining them and kind of be on the front end and creating these kinds of massive 2.5-day events. And we're doing it again. We're bringing it back. Everyone's kind of comfortable getting back together again. I think it's the best way to network. I go to conferences throughout the year constantly, and these events are always a wealth of knowledge and expand my network every single time. Instead of me talking about the Quest Expo event, you guys know it's a massive, not just IRA event. It's going to be on real estate topics, alternative investment topics, you name it, and just a big network opportunity. I'm going to show you a little clip. It's going to take 30 seconds of y'all's time before we jump right into the main meat of the presentation. Hope you guys enjoy.
Coming to this expo is such a wonderful learning experience. There are hundreds of other real estate investors to network with and to learn from. The education is such a wide variety in any type of real estate investing that you're interested in. You're going to learn it here.
So that's our Quest Expo. You can look at questexpo.com for more information and kind of see what's going on there, who of the speakers that we have this year. What are some of the topics that we're touching on? We're adding more speakers as we move forward. It's going to be in September of this year. The early bird tickets are right now for sale. So this event is one of the only events that we host that is not completely free. And the reason why is because it just takes a lot of money to put on these large scale events. And we have a lot of vendors there, about 40 plus vendors, 500 plus people, right? So please get a ticket early. It's a great event. You're going to want to be there, and you're going to want to wish that you got an early bird if you wait too long. The other thing too, if you are a Quest client, you get discounts. Please let us know. Please let Brianna know. We can also even give 15% off even if you're not a Quest client. She has a specific code. You just speak to Brianna. Brianna's going to put her email in the chat box there, just so you guys know. But let's get in the meat of the presentation here. Disclaimer, I'm not a financial advisor, a CPA, any of that, right? My job here is to educate you guys to make the best decision for yourselves, for your IRA accounts, for your investment opportunities, understanding what vehicles you can utilize and how to utilize them properly. But I will not tell you what to do. I would just tell you, hey, this is how you can do this, or if this is allowable within an IRA account. And hopefully you guys, with your expertise, can put two and two together and go on and make some returns in your retirement savings, tax-free, tax-deferred, whatever it may be. So for those of you who may not be completely familiar and are watching this and don't know what is technically a self-directed IRA, or may think a self-directed IRA is any different from a regular one, I'm going to debunk that myth right now. The terminology self-directed is actually just a marketing term. We created, or the industry has created, a term self-directed to really just differentiate an IRA between one that you may have at Quest or one that you may have at Fidelity, Charles Schwab. That's the biggest difference. Legally speaking, they're identical. The IRS actually doesn't acknowledge the terminology self-directed. That's not a legal term. To them, it's just an IRA invested into real estate or whatever it may be. That's all it is to them. The rules don't change. They run by the same publication. But for us in day-to-day operations, because we might have multiple accounts, we might have one at Fidelity, one at Quest, we want to decipher that and we want to differentiate them. So we call these a self-directed. And it kind of goes with the abilities that you have with these plans, some of which are here. One, diversification. As you self-direct, you can choose where to invest your funds, right? You're not just limited to maybe the stock market or mutual funds or opportunities that these brokers are giving you. You can actually diversify and jump out of that and go into something that maybe you're at a conference, maybe you're at the Quest Expo, and you found someone that said, hey, I'm raising capital. I'm looking for private capital investors of $10,000 to $25,000 each person, right? And you have that money in a retirement account. You can possibly fund that. That's an alternative investment for you to fund into. That's diversifying that portfolio. A lot of clients right now are happy that they're diversified because, as you may be aware, the stock market's not doing too hot right now with everything going on in the world. And that is the volatility that you experience with that kind of market. However, if you diversified your funds and you're invested into something that just doesn't really go off of what's happening across the world, it kind of goes on what's happening with who you made the investment with, then you're probably in a safe boat, right? If you're owning real estate, your property's just appreciating right now, and probably can sell for a lot of money, right? So people are kind of feeling comfortable right now in self-directed IRAs. People in the stock market right now aren't feeling too comfortable. The other one is tax savings. We'll go over the 7 types of accounts and kind of touch on each one's benefits and why they give you tax incentives or tax savings. Each one's a little different. Some give you tax deductions, some give you tax-free growth, some defer taxes until you retire, some come out tax-free for certain expenses. So we'll touch on those when we hit 7 types of accounts. The other one is social investing. So this one's nice because you can invest into your community. You can invest within your personal network, right? If you are a circle of individuals and investors that are constantly doing deals, you can fund your buddy's investment and they can fund yours, right? So it's just, you're investing into your community. You're investing in people that you know, not necessarily just funding, public, large Fortune 500 companies. And then the other one is invest in what you know best. I think this is the most important one. Everyone I speak to that comes to Quest is somewhat entrepreneur. Someone wants to get into that space, learning about it, whatever it may be, but wants to jump into a different space and kind of take control of their funds. So as they educate themselves or are already well educated on topics such as real estate, we'll use that as an example. If you utilize your IRA capital towards that asset like real estate, ideally, you give yourself a better return. Ideally, you can make more money in that, right? So investing in what you know best is really a really key thing as opposed to someone else controlling. Now, to each their own. You can go both ways, right? I'm not saying one is better than the other. It's just another opportunity for you guys. So when we jump into the personal plans, and these are 7 of them, There's 3 categories. Feel free to send a question into the chat. If it's a good question, if it's one I think we should, show to everybody, I'll put it on the screen and I'll go ahead and address that question. If it's a little bit out of order, maybe we're touching on it later, I'll just let you know, hey, we'll touch on that throughout the end of the presentation. So the first 2 plans, the most popular plans, are traditional and Roth IRAs. So the Roth IRA is the one that every guru says you should have one, right? Everyone says that a Roth IRA is for everybody. If you don't have one, you should get one now. And I agree. It's kind of a glorified savings account. Before we touch on that account and what the details of that account is, the most common one actually is a traditional IRA. And you may guess it, but the reason being is because most of America has retirement funds in old 401ks, in rollover IRAs, and funds that have not been taxed yet. And so when they transition their money over to a self-directed account, that transitions over to a traditional IRA. A traditional IRA is just a pre-tax bucket of money. And so that's kind of the most common thing people are doing. And so just it's an easy move, it's non-taxable, you don't get penalized. It's 1-2 step. So most people fall under the traditional IRA category and then just invest through there. Other people may be starting from scratch and want to set up an account, and they don't want to necessarily use a traditional IRA. They don't need a tax deduction, which is a benefit a traditional IRA gives you if you put money into it. They want to just put money away and then invest it. And they've been told a Roth IRA is the way to do this because it gives you tax-free money. And that is pretty true. It gives you tax-free money once you retire. So the thing about the Roth IRA is I put money in, I invest it, and as long as I keep that money I've earned in the account up until age 59 and a half, which is round up and say I'm 60 years old now, at that point, now I can take money out of the Roth IRA completely tax-free, no matter what's in the plan. Now, what's also nice about the Roth IRA, which I like, especially for young individuals, maybe or anyone really starting from scratch, is the money that you're putting in the Roth IRA, your contributions, is completely available to you at any point in time. So if I take the next 10 years and I commit to putting money into the plan, the maximum being $6,000 for anyone under the age of 50 or $7,000 for anyone over the age of 50. If I take the next 10 years to put in $6,000 into the Roth IRA plan, at some point I'm going to have $60,000. And theoretically, I should have been investing that throughout the years, and that should have been also earning funds. But let's just say on the 10th year mark, I've decided, you know what, I want to go on a massive vacation. I want to go buy a property to live inside of, or I want to do something that I can't. It's not an investment. What I'm trying to say, I can actually take out my 60K. It's money that I've put in. The IRS says that's your money. What I cannot touch is actually the earnings. So throughout contributing, throughout investing, letting compound interest do its thing, it's also, let's just say that account is now worth $80,000 or $100,000. Well, that $20,000 or $40,000 earnings I cannot touch, right? That's the caveat. But understanding that the money you did put in, you can touch, which I think is a huge benefit. Some people don't know that. I touched on the contribution limits for the Roth. Same thing goes for traditional IRA. The benefit of traditional is just I get tax deductions if I put money in. If I qualify for tax deductions, if you make over a certain amount, you might not even qualify. As I invest that money, like a Roth, instead of it growing tax-free in a Roth, in a traditional, it grows tax deferred. Just means that when I do turn 59 and a half, I take money out, that I will pay taxes. The idea behind that and why that was created is ideally you're in a lower tax rate than you were before in a traditional IRA. So you're paying on that money that grew, not at your highest, but at your lowest. That's the idea behind the traditional IRA. Now, when someone wants to transition money, let's say, like most America has, traditional IRA money, pre-tax dollars, and they have a really good deal opportunity of, let's just say, $20,000. They can actually transition and say, instead of doing this in a traditional IRA, deferring my earnings later on in taxation, I can actually just get tax-free earnings. They want to convert that money, just transition the money from traditional to Roth IRA. That's what's called a Roth conversion. It's going to be done at any point in the year, and anyone can do this, no matter income, no matter what. But what happens now is that $20,000 that I plan to transition from a traditional to a Roth IRA becomes taxable income to me this year. If I did that today in 2022, what ends up happening is $20,000 gets added to my 2022 income. Come 2023, before April 15th, I file taxes, I will be adding $20,000 to whatever I made in 2022. And based off my tax rate, using the marginal tax brackets, that's the percentage that I will be paying taxes on and owe taxes for. So people sometimes do these Roth conversions in years where they're not making too much income, maybe years where they didn't have a job, maybe years where they have a lot of deductions and they're lowering the taxable income, or just simply they're going to make a great deal. They have the cash available to pay the tax liability, and they want that money to go tax-free, and they bite the bullet now as opposed to paying it later. If you take it to the extremes, if you have an acorn, a tree, you know it's going to turn into a tree, you'd rather pay taxes into it for the acorn, not for the tree. All right, so that's the idea behind it. That class on our website is called Roth Conversions. So employer plans, these are the other section of account types that you can have. Anyone watching this is a self-employed individual, has their own business, they most likely qualify for one, if not all of these plans. The SEP IRA being the most common plan. This plan is usually for entrepreneurs who kind of work for themselves, don't really have, any employees full-time at least. They may contract out, but they don't have full-time employees, really them themselves, maybe their corporation, whatever it may be. An example of this might be a realtor. Right? A realtor works for themselves. Right? Their job is really to go out there and sell properties. And whatever they make over a course of a year, they're not being given a 401k. Their employer is not going in there and giving them match incentives. So they got to create that retirement savings for themselves. And a SEP IRA might be a good vehicle for that. A SEP IRA will allow them to put about 25% of their net earnings into a retirement savings plan. Use that as a tax deduction and then invest that money. So you're kind of creating your little mini 401k there if you're a self-employed individual that doesn't have any employees, or maybe has very few, but usually people don't. That is a great plan for you. It's also pretty easy to administrate. You administrate at any custodian, Quest, or even a Fidelity Charles Schwab will open these accounts for you. Very easy to utilize, and they're personal plans. They're like traditional IRAs. They can be invested into whatever it is that the custodian allows you to. If it's at Quest, you can do private transactions. If it's at Fidelity, you can invest in the mutual funds. So it's a very, very easy and straightforward employer plan you can set up for yourself. The simple IRA plan is usually for small businesses that do have employees. A great example of this is dental practices. If a dentist has 8, 10 employees and they want to create a mini 401k plan for them, simple IRA might be a solid choice. It's very cost effective for the employer. It's not expensive to maintain. What it does is it allows you to create these simple IRA plans for each individual employee. Each individual employee can then contribute to it personally. Maximum they can contribute a year is $13,500, or maybe $16,500 if they're over the age of 50. And then the employer, dental practice, can actually come in and contribute, whether it be 2% or 3%. There's a 2% non-elective or 3% elective to kind of match them. And so that's a nice little plan for you to create if you have employees. And again, it can be completely self-directed. Now, these aren't too common, and the reason being is that typically the employer is the one choosing the simple IRA plan. And then typically that employer, when they come call us, they're the ones that want to self-direct it. But hear me out. What if you had 10 employees and you told them, hey, I'm going to create you a simple IRA plan, but I'm going to go ahead and throw in a self-directed simple IRA plan for you, so you can go ahead and invest into real estate. But that individual doesn't necessarily know how to do any of that, or they don't want to do any of that. That might not work out for them. So what a lot of times happens is these simple IRA plans get set up for the employees at a, let's say, Fidelity Charles Schwab. Very simple. So, hey, your account's going to be over here. You can invest in the stock market. Everyone understands that pretty easily without having to do too much research. And then you, as the employer, as the business owner, can actually transition your simple IRA wherever you want. And you can have yours at Quest, and yours can be invested and made self-directed. So that's typically the relationship we see happen between these simple IRA plans. And then the last one is a solo 401k. This one is very, very sought out, especially for entrepreneurs, especially for individuals investing into apartment complexes and syndications and such. They're talked about a lot. If you're a self-employed individual, you can potentially funnel in about $61,000 into this plan a year. Now, there's a way to get to that number. However, it is possible. It's kind of a combination of a SEP IRA plan and a simple IRA plan on steroids. The caveat, though, in order to qualify for a solo 401k, you have to be completely self-employed, and you cannot have any full-time employees, and any companies that you own. And that does not include, I should say, a spouse. So a spouse is the only employee that you can have as part of your business and qualify for solo 401k. Just keep that in mind. I won't go into too much detail on that one. There is a class that we go into the detail of all three plans. And there's even an additional class that just talks about the solo 401k, actually taught by myself. So check it out if you are interested in one of those plans. And then the last one, the specialty plans, the HSA or the health savings account and the covered out education savings account, or ESA for short is what I call it. The HSA plan is very, very common. I love the HSA plan. I have one myself. If you're not familiar with it, essentially what it is it is a retirement account. You put money in. Now the money you put in, you actually can take a tax deduction on it as well. Then you can invest it. And this can be, again, I have one at Quest and one at Bank of America. So I do both stocks and I do also notes with my HSA. So it kind of depends what I'm feeling and what investment opportunities I have. So you can do both. It can be self-directed. And your HSA plan can now invest, grow, and it can take money out at any point in time, no matter your age, as long as that money is being used to pay for medical expense. But here's the catch. The medical expense, qualified medical expense, there's a long, long list of things. The general rule of thumb is it must be for your health. It can't be for cosmetic reasons, right? It can't be for anything like that, but it has to be for your health. A doctor's appointment is a really prime example, and that would work, right? So when you can use the HSA immediately, if I invested, made $1,000, I can take that money out and pay for any medical expenses that happened. The other cool thing too, if you're a very healthy person, barely go to the doctor and don't necessarily have too many medical expenses, well, you can actually use the funds to reimburse you for past medical expenses. So that's a huge, huge bonus for the HSA plan. The other thing I want to say is that it doesn't just stop at actual doctor visits and such. For example, the glasses I'm wearing right now, I need them to see. I'm blind as a bat. So I actually use my HSA plan to buy these glasses. Prescription glasses count. There's a lot of benefits that you can have from this. So keep that in mind. The covered up education savings account, fairly similar, but you guessed it, it's for education purposes. It's actually for children. So if you have a child, a grandchild, a niece, a nephew, whatever it may be, you can actually set up these ESA plans for them. If the child is under the age of 18, you can open the ESA plan, contribute to it, add money, and invest. Again, you can invest it self-directed, however you like. And as it makes money, it can actually come out tax-free for the child's benefit for the educational expenses. And this is where actually it's not as specific. I mean, it's actually a lot of things you can use them for. You can use it for laptops, uniform, books, tuition, room and board, things of that nature. So it is very powerful. Now, there are caveats to this one as well. Like I mentioned, the child has to be under the age of 18 to start it. They can only hold on to it until they turn age 30. Once they turn 18, you can't no longer contribute, but you can continuously invest it. And you can only contribute $2,000 a year for the child into this plan. Now, the cool thing is, if, let's say, child one has an ESA, contribute to it, you're investing into it, you're growing it. Child one also ends up getting a scholarship, full ride, don't need the ESA anymore. Well, what you can do is you can actually pass that down to maybe child number two or someone else, right? Or they can hold on to it. And when they have a kid, if it's before 30, they can probably pass it down to their child, right? So it can actually live on. So it's a cool, nifty ESA account or nifty IRA account that can be utilized for things right now, for expenses that we have today's day. I have a question right here from Howard. I'm just going to address before we move on from the HSA stuff. If a person with an HSA uses it for past medical expenses, they will need to refile in the year they were using to reimburse, correct? So the thing is, actually, in this situation, that medical expense, although it was passed, it would come out as a distribution from the HSA in that same year. And it would be reported as a distribution from the HSA in that given year. So if I say I took out my distribution of $1,000 to pay for medical expense that I incurred last year, then what happens is, one, I should keep my receipts 100%. But I'm going to report that as a qualified medical expense on this year's tax form. The one that the HSA reports is actually a 1099-SA. And that's the form that shows you how much you've taken out of an HSA plan. And if you just tell, hey, it's qualified for a qualified medical expense. In the cases of an audit, if the IRS comes down and says, hey, prove to me that this was for a qualified medical expense, that's where you want to have that receipt. That's kind of how that functions. Great question. So all of these plans, and I've alluded to it, I've mentioned it a few times already, all these plans can be self-directed. All these plans can actually be utilized in conjunction. You don't have to choose one or the other. If you're an individual that was thinking, hey, I'm probably qualified for multiple of these, you could probably use multiple of these, you probably can. There is something that's very important for anybody that's a Quest client right now, or thinking about becoming a Quest client, or any just IRA custodian client. Understand that the IRAs have their own legal name. Whenever they make investments, that name is what appears on contracts. That name is what appears on deeds, on notes, whatever it may be, as the investor, as the owner. And it's very, very important that the IRA is represented properly. And so what we're looking at here is the investing of the name of the account. The example and the formula for the way it works is Quest Trust Company, FBO, the account holder's name. So we use the example of John Smith here, IRA, and the account number. That's the legal name of the investor. In situations where you may be using multiple accounts to come up with a sum, let's just say you're doing a note of 100,000 and you're using 50,000 from one account and 50,000 from another account, well, then that also can be used. But on that note, on that contract, it will read something like this, the partner vesting, right? So you add a little line to there, it says as to an undivided 50% interest in this situation. That could have been 75-25, whatever it may be. But keep in mind, it's very, very important when it comes down to the actual investment side of things. And we'll go over, I have 2 case studies, so we'll go over that and we'll kind of explain how that works. Before we get to the case studies, though, we got to talk about what you can't do in an IRA. If you can kind of decipher what you cannot do in an IRA, then you know what you can do, and that opens a lot of doors. So it's people, transaction, and investment restrictions. The people restrictions, the first person is disqualified persons, and the first person that's disqualified is always yourself. So the IRS never wants you to gain a benefit from your retirement account until you do it in a qualified manner. So prior to that, you just want to know, you can never transact with yourself. If you're on the same side, different sides of the fence, I can't loan myself money out of my Roth IRA. I can't buy a house in my IRA account and then me live in it, right? I can't own a property under my name and then transition all the earnings to my IRA so that those are tax-free instead of me paying taxes on it. Can't do that. So understanding you're the first disqualified person to your IRA, you can't transact with yourself. Then there's a list of other people. Now this is kind of a weird list. You can take a picture of it if you want. However, I'm going to sum it up for you. We always know that yourself, you are disqualified, but it also moves on to more people. So far left of this graph here, you see your family. It goes up and down the lines, your ancestors. So it starts to your parents and your grandparents, goes up that line. Then it goes to your spouse. Then it goes to your kids, their kids, and their kids, right? It just goes down that line. And also the spouses of your children are also included as disqualified persons. So examples, I can't take my IRA money and then loan it to my son to start a business. I can't invest and buy a property and then have my son live in it, my parents live in it in retirement age. Can't do that. So on top of that, the rest of this graph, what it shows is that not only those people are disqualified, but certain companies that those people own, control, manage, or maybe highly compensated by. And this just kind of goes into more detail. That's kind of the overarching kind of message here, right? Yourself, spouse, kids, parents, their spouses, and people and companies they own, control, manage, or highly compensated by are disqualified to your IRA. If you're transacting with anyone that's not on this graph, you're probably in the clear. So we know that you can't loan, sell, buy, but the biggest one that I think the IRS has gotcha card is extension of service. They actually write that an extension of service is a prohibited transaction. Prohibited transaction is essentially what they call something that you shouldn't have done and can blow up your entire IRA. So the one they have is a gotcha card as an extension of service, and I think the easiest way to include what that means is, let's say an example, I have a property in my IRA account and I got to mow the lawn. Instead of paying someone to do it, I end up just going there on a weekend, a lawnmower. I go in there and just do the work for it. That way it doesn't have to charge the IRA, I have to deal with that hassle. I get it. Probably easy to do that. Probably very quick for you to do that too, especially if you enjoy it. However, technically what you've done now is you've extended your services, your personal services. And the IRS can say one of two things. One, you've extended a service, that's a prohibited transaction. You're not a person that can mow that lawn on an IRA, on an asset that's owned by your IRA account. Just you've given it a benefit by not having to pay someone else. Or two, they can say you've over-contributed. You have now contributed to your IRA, your time, your services, and not cash. and they can penalize you for that. So depends on, I guess, how they're feeling that day, but they can say both those things. So I would just stay away from those kind of situations. And then there's investment restrictions, things you actually just cannot invest into: life insurance, contracts, and collectibles. So collectibles, there's just no thing that we can value. So it's very difficult, right? Art is a prime example. If I bought art in my IRA account, to me, that might be worth $1,000, but to you, it might be worth $1 or nothing, right? You might not find it valuable. So collectibles, they just keep it out of your retirement accounts. And so same thing with life insurance contracts. What can you invest into? These are the three categories that we break Quest into: real estate, private entities, and promissory notes. They're the most common asset classes that we see. The private entities department deals with a lot of things that may not be too obvious, right? When we talk about real estate, we know what single family are, we know what options are, we know what commercial property is. When we talk about promissory notes, pretty obvious. Private entities, kind of more vague, right? Typically private companies, but what is that private company doing? Can be a whole lot of things. But at any point in time when you're investing into a private company, a fund, whatever it may be, at that point in time, you're probably going to deal with that department, and they're going to help you fund it. This is the category of the most common things like syndications, equity funds, debt funds, things of that nature. And then the steps that you take to do these kinds of things. Step one, you got to open an IRA account. You got to open a self-directed IRA account. Step two, you fund it. How you fund it? Either transfer from an existing IRA, either roll over from an old 401k, or you simply contribute to it, and you add funds to them. And that's where they have the limitations. Transfers and rollovers don't have limitations on how much you can bring over. Number three, you find your investment. This is where the key term of self-directed takes to play. You locate your investment. You are the captain. You're the one deciding where you want to invest your funds. You tell us, hey, I found this opportunity. I want to use my IRA to invest into it. And then we start working with you to help you out there. Four, some investment forms. Now, luckily now we actually do a lot of things online through your client portal. You actually go on there, submit your investment, submit investment details, things like what account are you using if you have multiple, things like how much are you funding, where's the money going to go, what's the company you're investing with, or what's the house you're buying, whatever it may be. We need those details. Otherwise, how are we going to send money? We're not going to send money just saying, hey, wire money here. So our investment forms, when you finally complete those within 24 to 48 hours, we'll fund that investment. And then all the profit made from whatever you just did come back to the IRA account. But the key thing is that you located your investment, you did your due diligence, you did the work there. We kind of serviced you and helped you get there. All right, so let's get to the real estate case study here. I have two case studies, and hopefully, let's see here. Yep, we got enough time. So we should get to both. So the first one is a typical rental property situation, and the situation is actually where two individuals went on this deal together. So took out the names and kind of rounded the numbers a little bit, but basically the general idea of this actual case study is still the same. So they actually wanted to buy an office condo. $250,000 was the asking price. This is obviously not today's day, but $250,000 was the asking price. And each of them had money in SEP IRA plans. They were self-employed individuals. That's just the plan types that they had. But great. They each decided to open a self-directed IRA account and transfer over from the current SEP to another SEP, so self-directed at Quest, 150. Now, I know they transferred over a little more than they needed, but they did it for a good reason. Now, 150, they moved it over. Then they're going to make an offer to purchase the condo. That offer has to be made in the names of the IRA account. So you see that there in blue. One thing that's just not showing here is what the interest, the 50% of each person is not showing there, but it'll be the next slide. They also complete what we call our direction of investment, that client portal thing we just spoke about. They go on there and they actually say, I want to invest into this property. I'm going to buy it for X amount. I'm going to put this much towards it. I'm using this IRA account. They just basically just go on and basically sign and submit the investment opportunity to our real estate team in this situation. We sign the contract, and we also send the title company the earnest money. So as the IRAs are making the investment, we're the custodian. We got to sign. John and Jay don't sign, we sign. John and Jay gives authorization to do so. And then we also send the earnest money. In this case, was 10 grand, $5,000 from each IRA account because we're going in 50-50. At closing, we send the full amount. The title company records the deed, and that deed records as the following: Quest Trust Company, FBO, John Woods, SEP, account 1245, as to an undivided 50% interest in the next one, right? So remember, that's why that name is important. That's what shows up on the deeds and the contracts. Those are the owners of the condo, not John and Jay. John and Jay are the brains of the operation. The IRAs, the actual owners. What they ended up doing is they actually ended up hiring a property management company to oversee the unit, put tenants in there, etc. Makes it easy for them. Makes it passive for them. Doesn't have to do day-to-day operations. The management company does that for them. So rents are handled by them, and then the rent on a monthly basis is $850. So half that, once that comes back to the IRA account, that's $425. Right, in their step plan, it's tax-deferred money. Once they submit the proceeds, basically, John and Jay can see those all through the client portal. Fast forward a little bit. It's going great. They've been receiving monthly payments. The tenant actually wanted to buy the property. The tenant actually, I think, was a dentist and wanted to put some things in, wanted to renovate the building and kind of make some changes. And they wanted to buy the property. So after 2 years of receiving rent, they got an offer of $395. John and Jay looked at each other and said, "Sounds great." So they ended up selling the property. The IRA sells the property to this new buyer. And at closing, this is what they received. So their initial investment was $125 each. They received over 26 months, over $11,000. And the gains from the sale from each IRA account was $62,500. Each IRA after sale received back $198,550. That includes your principal and what you made in just 2 years. That's a pretty solid investment. But it could have been better. So as we mentioned, this was a SEP IRA plan, meaning the money in there we're giving them tax deductions when they're putting money in, but was growing tax deferred like 401ks, like traditional IRAs. What if they did in a Roth IRA? In a Roth IRA, that would have been completely tax-free earnings to them, right? That's the only way that probably this deal would have been any better. Otherwise, John and Jay, I think, hit a home run on this one. But key things to remember is John and Jay found the property. John and Jay put a management company in place. John and Jay didn't do those services themselves. John and Jay also, they never touched the money. The money went from the Quest Trust Company to the title company. And when the rent came in, it went from property management company to the IRA. And then when they sold, same concept. John and Jay were just kind of the brains of the operation the entire time. And the entire time, they also split things 50-50 because that's how they went in. But they could have gone any other way. I told you that they moved over a little bit more than needed, and the reason why is because they wanted to have a little buffer because with real estate comes expenses, and you want to make sure that any expense that comes up gets paid out of the IRA accounts that own the property. Right? You can't go in there and pay that expense yourself, so that's very, very important. And the second one is actually a personal one of mine. So I'm going to share with you kind of something I did a few years ago with a Roth IRA. And it's a promissory note. So promissory notes are the other kind of department that we have out of the three transactional ones. Very common. This is the case where IRA loans someone money, and that loan, that contract is completely negotiable between all the IRAs involved, or the IRA owners involved, and the borrower, right? So Quest has no power in negotiating this for you. It's a matter of you guys doing it. I had to do it. It's not that difficult. I actually liked how it was. It's very passive, very easy to happen. Just a little background information. The way this one worked is actually a friend of mine. She told me that she has an opportunity. She's done loans with a certain investor multiple times before. Every single time they've paid back. And at that point, that kind of gave me a sense of security. But they're looking for a larger note this time, and they're looking to bring in money from different areas. She couldn't fund it all herself. So she pulled in a few friends that have money in retirement accounts to fund this deal. And it actually ended up being from 9 different IRA accounts. The promissory note total is $157,000. So that's a pretty hefty note there. However, with the 9 IRAs, they were able to make that up and split it accordingly based on how much they put up, each person. And so she was like, "Hey, if you want in, you can put whatever you need. We just got to get to the certain number." And I said, "Great." Did my research, spoke to the borrower. Turns out I actually knew him as well. Has a great reputation. And I felt comfortable doing this deal. And not only that, it was also a secure note. So we'll get to that in a second. This little paragraph right here, I kind of blacked out a bunch of people's names. However, what it's showing you actually is just everyone's IRA name written in there, the same way you saw John and Jay, but it's 9 of them, so it gets pretty lengthy. But this is actually on page 1 of the promissory note when it said who the lender is. So it starts with the words Quest Trust Company FBO, person 1, IRA 1, 2, 3, 4, 5. That person was 50% interest. That person had most of the cash. And it goes all the way down to the ESA. And it says, and ESA 1, 2, 3, 4, 5, 6, 7, right? 1.9%. So it went all from a large account all the way down to a very small ESA that only put in $3,000. So that individual was a child of one of the parents that were involved in this note, and they threw in their ESAs. That way their ESA gets a piece of the pie. So this promissory note was a first lien position. If you borrow a default, we could foreclose on the property. It was a very well written note that really laid out what happens if you don't pay us back in a certain time frame. We gave the borrower a year to pay us back, knowing after conversations that his goal was actually to pay us back a lot sooner. And he did. And so essentially, at the end of the day, we got 12% interest over a few months. I think it ended up being about 9 months or so. But we made $18,840, and everyone got their piece. The first person that invested 50% got 50% of that, and the ESA got 1.9% of that. But it was a pretty good win for the ESA and a pretty good win for even the large account, right? So multiple people used their account here, and it was a pretty quick turnaround. Now, the coolest thing about this is that all the accounts that were used were accounts that give you tax-free benefits. There were ESAs involved, there were HSAs involved, and there were Roth IRA involved. None of the people use any traditional IRA money, SEP IRA money, nothing like that. So all $18,000 of that money eventually will be used by multiple people, but it will come out completely tax-free. The other things to notice is that Quest was the facilitator of the investment, but all the people involved, at least the adults in this case, were the ones negotiating with the borrower and made sure they all came down to an agreement. We're the ones setting the terms, and we're the ones that were reviewing the documentation and telling Quest, I want to make this investment. So again, it falls heavily on the individuals that own the accounts to make sure that you are doing your homework on the person. It's not always going to be a home run, but these, I think, our little wins are good too. And you always are not going to be guaranteed to be paid back, right? So there's risk with everything. So make sure you vet your borrower. Make sure you have that conversation with them. What happens if you don't pay me back, right? Have that place and plan. And if you can, if you're a lender, maybe even have your attorney draft up the note to have your best interest in mind. So as we kind of get closer to the end here, for those of you that may be wondering, how can I use these IRA accounts to profit? Now we have a solution for you. It's called OPI. We'll be talking about it the entire time. Other people's IRAs. So if you're an individual on this call that raises capital, that borrows money, as you can see, there's a lot of money out there in retirement capital. Just at Quest alone, at any given moment, there's $300 million in cash sitting, waiting to be invested. Not being used, just waiting to be invested. So you can tap into that. How do you tap into that? Talk to your network. If you have a network of individuals and they're raising capital, ask them, not only do you have funds that you can invest with me, but do you have retirement capital? Did you know you can invest your retirement capital with me too? To you as the borrower, as the person raising capital, it's the same thing. It's as if someone gave you cash. But to them, they're using retirement capital that's maybe stuck in the stock market, not doing too hot, and giving them another opportunity, another solution to a problem. It creates its own private financing source. That guy that we loaned money to, when it came down to it, if you want a second loan, he probably had 9 other people that were saying, yeah, cool, let's do it again, right? So it's a great, easy way to have a private financing source. There's trillions of dollars in retirement. There's $300 million at Quest in cash. We have more than that in just assets in general, but just the cash, $300 million. But there's so much more in other custodians. There's so much more just around the country. And there's so much more that people don't know they can self-direct, right? Waiting to be tapped into and kind of utilized. It's a win-win scenario for everybody. Every gathering, there's millions of dollars in retirement accounts. I go to a lot of conferences, and everyone has some sort of money tucked away for retirement in one type of vehicle or another. They just need to be told that they can invest them into self-direction, into self-alternative investments, and it's a pretty simple process. If you don't know how to do these processes, you don't have to be an expert. That's the reason why we have us, right? There's about 9 on my team that can answer questions at any point in time. There's multiple CISBs, IRA services professionals at Quest Trust Company. You always get help. You always get a person that can answer your question, or we schedule a call pretty quickly to help you out with that. This is how you get in touch with us. It's fairly simple. There's 3 ways. Live chat, I love that one because you can go on the questtrustcompany.com website and quickly, immediately talk to someone right then and there. If you go on there right now, you can test it. You can say hello, someone will say hello back. And it's not a robot, or they're not in another country. They're probably in Houston, Austin, or Dallas. And then the other one is phone call, 855-FUN-IRAs. Give us a call. Say, I want to speak to an IRA specialist. Call me out by name. Say, I want to speak to Wanda Shawn. Say, I want to speak to Brianna Clayton. She's out moderating this call right now. You can speak to us. Or email IRAspecialist@questtrust.com, and we can talk to you through there. We can schedule a call, whatever it is that you may need. And the last thing, the last thing I'll leave with you guys is it's huge. Join free educational webinars. These are happening on a weekly basis, constant topics. As I mentioned, we do this basics class once a month to really kind of reiterate that and keep that fresh for anyone jumping in. We have virtual networking happy hours, meaning you can actually go on there and pitch deals. We have STRA socials, STRA Saturday classes that happen at noon, all online. The next one I want to invite you out, if you are an individual here in Houston, we're having our social on April 5th. That's going to be the afternoon. It's the first Tuesday of the month, first Tuesday of April. And what we're doing, and one thing we're bringing to Quest, which is brand new, is actually the ability to invest into cryptocurrencies. Right, so we've actually teamed up with ErisX, a company, a platform that allows you to invest into crypto using retirement accounts. It's a vetted process that we understand that we can transition funds now from the Quest platform over to their platform to go ahead and trade coins. And if that's something that you're interested in or looking to learn more about it, well, then who better to teach you about that than the CCO of ErisX? He's coming down from New York to come down and talk to you guys, meet you guys in person. This happens at our Houston office. If you're not in Houston, no worries. This will also be broadcasted live, completely free event. Now you can see it's from 6:30 to 8:30, so it's a fairly long event, but we do provide snacks, drinks, food for you guys to enjoy and networking a little bit before the presentation. But please come out to that event as well. I think it's going to be a huge benefit for a lot of people as we transition to different markets. And then the last one I'll leave you with is, again, questexpo.com. Check it out. Early bird tickets will end. Right, you want to make sure you get in on that early bird ticket price. If you can snag a VIP ticket, those go by first. Those are the best tickets that you can get. You get front row seating. You get exclusive speakers. You get lunches with speakers. You get the really enhanced experience to really network with all the individuals that you want to meet. If you're serious about it, check it out, questexpo.com, and it gives you all the details that we have thus far, and we'll continuously update that page as well. And as I mentioned, if you're interested, Brianna, throw again your email again. If you guys email Brianna and say, I'm interested in the expo, she will give you a 15% discount code. Right, so that way you guys get a discount right off the bat. If you're a client of ours, let us know as well, and you get an additional discount code. So there's a lot of opportunities out there, and it's going to only get more expensive. Get the cheaper ticket now. Contact us, as I mentioned, website, call us. My email's there as well if you want to shoot me some information, anything you want. Or please come to our events. That's the biggest thing I would say. So I hope you guys enjoyed the presentation. Thank you for spending your lunch with me, and we hope to see you at the next one. Thank you guys.